Thank you everyone for joining this section. For those of you who don't know me, my name is Owen Lau. I cover capital markets, technology, and digital assets at Oppenheimer. So when you trade, you need data to support your decision. Similar to equities, crypto also has a lot of data available to support investment decision. Many of these data are on-chain, but for outsiders, it's not that straightforward to pull the data directly from blockchain. And there are different business models to utilize these data. So to talk about this topic, today we are super excited to have Josh Frank, co-founder and CEO of the TIE, Shawn Douglass, CEO of Amberdata, and also Michael Gronager, co-founder and CEO of Chainalysis. Thank you for your time, Josh, Shawn, and Michael.
Thank you.
So for the people who are listening to the webcast, please feel free to submit your questions online, and I'll do our best to address your questions. So without further delay, maybe can we start with just a brief introduction, and each of our panelists, can you talk about what your firm does? Maybe we can go with Josh first, and then Michael, and then Shawn, please.
Yeah, so at a high level, the TIE solves a major problem, which is that if you go and you walk into a hedge fund, an OTC desk, a prime broker, an asset manager's office, and you ask them, how are you staying on top of crypto from an information perspective? They'll pull up their monitor and they have 40 different tabs open on their desktop. And every single person that we speak to has 40 totally different tabs. And what we do is we basically aggregate all that information together in a single tab. And so today we serve about 150 of the largest hedge funds, market makers, OTC desks, et cetera, in the crypto space, and really offer them a single front-end interface to interact with the crypto market. We aggregate market, derivatives, sentiment, on-chain news, governance, developer data, you name it, really as the home screen for institutions to interact with crypto.
Cool. I can go next. Mike Gronager, Chainalysis. Chainalysis is data platform. We look at on-chain data. So as you mentioned, like everything is on-chain. So what we do is that we have we scan through all the blockchains out there, and we look at the data, and then we connect the different transactions together in clusters, you could say, and we do that from smart algorithms that look at data, but also from a lot of ground truth data. So we have a very big data sharing network in crypto, probably the biggest in the world. We have 800 private sector customers sending data in real time, 200 public sector customers in 50 countries in the world. And all of those shares data with us that basically creates a unique data set that enables you to do a lot of different things. The number one thing that we monetize is clearly investigations into crypto. Public sector revenue of us is 60-65% or so. Then we have the private sector. We help with compliance and business intelligence. And these are other use cases. We're a B2B SaaS company, and basically sell per seat licenses for the public sector, and for the private sector, it's mainly transaction volume based.
So for Amberdata, what we do is we do comprehensive digital assets data where we connect into every spot market, derivative market, options venue, as well as collect on-chain data. Think of that on-chain data as fundamental data, as well as accounting data. And then we empower our customers to really span the entire value chain in financial services, whether they're building front-end applications like Josh, where they're doing research and analytics and insights or trading or portfolio management, middle office applications, whether it be treasury or risk, and back office applications, fund administration, tax, compliance, audit. We empower them to really not have to worry about the complexity of on-chain data, nor having connectivity into all the exchanges, so they can focus on building their business and adopting crypto.
Maybe let's stick with Shawn first, and then go back to Michael and Josh. Can you talk about the value proposition of your firm, and how do you differentiate your firm from other providers?
Yeah, absolutely. So Amberdata, we started in 2017, and we really defined the category for what it means to be comprehensive data. We're really the only data provider that provides super granular time series data from what's happening on chain, who held what, when, at what price, where did it go, who's participating in a decentralized exchange and a lending protocol, what's happening in ephemeral data in a mempool, to
what's happening on every exchange, full granularity of every, transaction in the order book for the price discovery process, aggregating that up to single asset indices and reference rates, and then extracting on top of that and creating proprietary data sets that provide lenses into, for my wallet that's participating in this DeFi protocol or this pool, give me everything that I need to know. And there's nobody else that really does that. There's a lot of people that provide point solutions for market data or on-chain data, nodes as a service. But what we do, we've defined the category and we've been staying ahead of that.
Great.
Yeah, and we've been around since 2014 for the last 8 years. And what we're doing is basically taking all the data on blockchains and attributing it in different ways. So now it's a service, this is a darknet market, this is a sanctioned address, and so on. And in working with both regulators, with law enforcement, with compliance professionals at crypto businesses and so on, it's extremely important that this data is the best in the world. Because otherwise you might send money to a sanctioned address, you get in a lot of trouble, and you have a lot of explanation to do after that. So clearly you need to work with the best data. And the way we stay on top of that is basically by having many customers. They give us data and share that with us. So that's one piece. The other way to stay on top of this is working closely with the regional providers in different countries, the different governments there, that will talk about what are the local problems there. And we have then a team of close to 100 analysts that will transact in multiple languages all over the world and collect intelligence and build out a very, very strong data set. And that's basically the value proposition of Chainalysis, the best data in the world with tools and the products that enables you to conduct investigation and compliance.
So for us, unlike these guys, we're really just focused on front office. So our clients we are really the home screen, as I mentioned before, for our clients. So I guess the coolest metric we have is our average client across 150 clients spends 3 hours a day on our platform. So we really are the home screen for hedge fund managers, traders, portfolio managers, CIOs, you name it, to stay on top of crypto markets, right? And so we are the platform that aggregates everything together. And what we do, which is unique to everyone else, is we're more of a, we have a tremendous amount of proprietary data. We also have APIs as well, which we can talk about, but we're really a platform. And in that, we actually even allow our clients to bring in external third-party data. So imagine, as an example, as a client of Bloomberg, you could bring data from FactSet or from S&P or any other data vendor into your Bloomberg terminal. We allow the same thing on our platform, right? So really building that home screen for institutions to interact with crypto.
Got it. I mean, usually for this kind of conference, we don't start with news in the early questions, but the news from the FTX is pretty substantial, pretty material for the industry. So I just want to get a sense about how does this FTX fallout or collapse impact your firm? Maybe let's start with Michael. You have a pretty interesting project. Maybe does it help your business at all, or it hurts your business? And then we can stop, and then we can go with Shawn and Josh after that.
So I think it's important to look at it in two different things that happens in the industry. First of all, I would say there's probably an expectation that I said throughout this year that there's no bear market in crypto. It's just overall finance is slowing down, and that's mainly driven by interest rate. I would say what happened now is that this is probably the beginning of a bear market. We've seen this is a huge impact. It usually has a huge impact. And there's some of those side effects where you will see some players being a little bit nervous about being part of crypto. They might delay launches of different projects, and you'll probably also see impact in terms of side effects of the crash of FTX, where you will see other firms getting into trouble. So there might be different customers of ours that would definitely hurt, and if they churn, well, we lose revenue on that side. On the government side, I think it has a slightly neutral to slightly almost positive effect, right? Because there's a more need for regulation, there's more need for oversight. Everyone wants to look at it further and understand what happened and what happens in crypto. So that's clearly a need. And then I would say the final thing is that in this process, there's a lot of understanding that hey, people might not have done the right processes. Like people don't learn. That's kind of what I say, because we don't. This is the same as Mt. Gox over again. But it's basically we need to understand, like, does an exchange actually have the customer funds? Do like all of these things, and that could be like products and services works around that. So I think that that's like a positive revenue stream. So I would say my assessment is like neutral to positive on the government side, and neutral to slightly negative on the private sector side for us.
John, you want to add anything on that?
Yeah, absolutely. So, if you look at what's happened, not even with just FTX, but if you go all the way back to Luna and Three Arrows, and you saw blowing up of, many of the lending platforms, that was counterparty risk problems and the liquidity crisis. They were over leveraged and they blew up. There was lack of transparency. People relearned about counterparty risk. That was crypto's Lehman Brothers moment, right? Then Three Arrows blew up. That was the long-term capital management moment again for crypto, because they were trying to arb across the price of Bitcoin and what was happening on basically an ETF. And now with FTX, this is the Enron moment, if you will, where it's, possibly a massive fraud that, and coming out of this, it's likely that we'll see different regulatory, frameworks come into place. But what it really makes the case for is you really need to understand crypto is radically transparent, and it is more transparent than traditional financial markets. We have the tools between all three of us on this call to see everything that's happening everywhere, and to understand flows of funds, movements in DeFi, risk on, risk off, in flows in and out of stable coins across bridges, to show proofs of reserves, and to really understand what is happening in a way that has never been able before in traditional finance. So I think positive things will come out of this, but it might be a little of a bumpy ride coming out.
Josh?
Yeah, I mean, this sucks. Like, this is really bad. I mean, there's so many terrible things that are going to happen because of this, right? I mean, all of the lenders that are impacted, right? The Genesis news shutting down Genesis lending, they were massive. There's an $8 billion hole. There's definitely not $8 billion worth of people tweeting so far to claim that they were part of that hole, right? And so there are clearly a large number of other people impacted. And there's a lot of knock-on impacts too that people aren't talking about, like all of the Bitcoin miners that weren't making money at 25 grand are certainly not making money at $16,000. And a lot of lenders took mining equipment as collateral, which is now trading at a 90% discount to what mining equipment was trading at before. Oh, and by the way, all of the 100,000 or 200,000 pieces of Celsius mining equipment is about to hit the market in 2 weeks because of their bankruptcy. And then that's going to impact miners more. That's going to impact lenders more. Like, there is going to be a massive credit squeeze in this market. I mean, Ontario Teachers was an investor in FTX. I think, pensions are going to be afraid, right? The last thing that you want to be doing is managing a teacher's money and have that all lost on a fraudulent exchange, which apparently no one did due diligence on investing in. So it sucks. It's going to impact every single one of us here, right? Like, I've had a handful of clients that have already told us that they've gone under. I'm sure these guys have as well. But it impacts everyone in the space, and it makes us look bad. It makes us look immature, right? So I think it's our job to show that we're building professional products and services, and there are real players in this space, but it's going to impact all of us. I mean, I think we're all positive on the future. We're all in crypto because we believe in it. I'm still wearing Bitcoin cufflinks, even though I bought these at 65 and now we're at 16, right? So, I think everything will be all right, but it's going to take a while.
Got it. So I want to stick with Josh. You talk about clients. So broadly speaking, who are your clients? Are they mainly crypto trading firm? Have you penetrated into other type of clients yet?
Yeah, so we're actually now signing, and I presume it's similar for Shawn, if I had to guess, traditional hedge funds and traditional finance firms at a greater rate than we're signing crypto firms at. For a number of reasons. The first is they're moving into the space. Second is they've managed their risk better, and so they've been less impacted by all of the nonsense that's happened. But we have a wide range of both crypto native firms and traditional capital markets participants. But we're really building a solution that's meant for somebody who's used a FactSet or somebody who's used a Bloomberg before. It's a piece of technology they recognize. A lot of the, I would say, younger, more crypto native generation, like they seem to be okay with using 750 different free tabs, which doesn't seem like a fantastic way to stay on top of the market. But they're also the ones that blew up. So if that's saying anything.
How about Shawn? Can you talk about your client base?
Yeah, absolutely. So we focused our business institutionally really early on. So we have some of the biggest banks in the world. Some of my investors are large banks: Citibank, National Bank of Australia. We have large traditional firms who are hundreds of years old and have been doing financial services for a very long time. Lots and lots of prop trading firms, lots of market makers, both traditional market makers as well as hardcore DeFi participants, as well as some fund admins. We power 3 out of 4 of the largest tax firms for crypto. And then we have 2 out of the top 4 accounting firms as customers. So really a wide spectrum, and they're very different use cases. Because think about on-chain data is fundamentals and accounting data. And then it gives you the ability to understand and quantify what's going on. But on the other side of that, you need to understand, you have to be able to account for what happened and then to be able to audit what happened to do proof of reserves for exchanges, et cetera. So it's a really wide spectrum. Generally, there are building applications on top of this, which is different than, say, Josh.
Got it. Then how about Chainalysis, Michael? I think about 60% of your revenue comes from the public sector. Could you please elaborate a little bit more on your client base? What do the public sector and the private sector use your tool for?
Definitely, yeah. So basically, one of the things that happened early in the crypto space and some of the connotations around crypto, like, oh, it's being used or abused for criminal activity in various ways. And there was we saw Silk Road back in 2013 being taken down. We saw other concerns in the industry and really being able to do investigations, like follow the money investigations in this space. Also map out certain threat actors worldwide. Take, for example, North Korea. They have stolen billions of dollars from different crypto projects this year alone. And being able to understand what's their next move is and where the fund moves and potentially freeze them is extremely important. So we are being used for that purpose from anyone from law enforcement to intelligence agencies to a lot of others, and that's worldwide. So that's basically in 50 countries in the world. So that's a use case on that side with around 200 customers in the public sector there. So then on the private sector side, it's a little bit more diverse, I would say, but the majority of the use case there is transaction monitoring. So if you onboard a client, you want to understand what's the origin of funds, are there any concerns? It's kind of a part of the KYC picture. And the part that we solve is KYC, know your transaction, what is going on that side. Then further on, if you look at, for example, DeFi projects, there's a wallet connect piece where you connect your wallet. They want to understand what kind of user are they dealing with, again, from a compliance point of view. And then as crypto has evolved, there's an increased need to understand things from a business intelligence point of view. So you don't just want to know whether the person is good or bad, as you would put it, but you also want to know what are they into? Are they into crypto gaming? And what games are they playing? What is going on when they're not on the platform? So simply starting to build out this business intelligence arm. So it's all about the data you can connect to your customers that way. And that's the private sector side. And the private sector side also counts a lot of bigger banks. It starts to get into crypto in various ways, as well as hundreds and hundreds of the crypto businesses out there, including 9 out of 10 of the biggest exchanges in the world are customers of ours.
Got it. Then what have you learned about the current crypto winter? I mean, we have some high profile blows up over the summer, like Voyager, Celsius. Now we have FTX. What are the things you think the industry should do to move forward from here? Maybe can we go with Michael first, and then Josh, and then Shawn?
Totally, yeah. So I think that I would say, as I said earlier, like I don't think we really had a crypto winter before now. I think that before now it was more or less like just impacts of the general financial slowdown that we saw in the market. I think what we are seeing right now is a real crypto winter. And I say there's things we should have learned already. So if you go back and look at, for example, Mangox were ran when crypto was considered glass pearls. So I'm not really pointing fingers at Mangox in that sense, because basically no one really considered it money and it was so early. There was no corporate controls in place at Mangox. There was no controls in terms of like reconciliation of accounts, what are customer funds, what is not, because no one really cared. It was just glass pearls. And then suddenly realized it was not glass pearls. They need to employ those, and realized that money were gone. They actually didn't know why. And then some fraud activity happened internally where they started to try to pump up the price. And then a little bit later, they were still out of funds. They couldn't get back into a positive balance sheet that way. So money was just gone. And I would say everyone learned from that one that you need to have proof of reserve that the funds are there. Only they didn't, because now we are here, right? We're here like many years later, and it's exactly the same. There was no proof of reserve. Everyone are like struggling in the industry to figure out, like, I want to prove that I have my funds, but it's not really something that we built into our normal corporate controls, apparently. And now you're seeing that for FTX, that there was absolutely not existent, and no one questioned them. There was a lot of high-profile investors that didn't do that. So I don't think we learn, right? We didn't learn from this one, even though we should have. And now it's a good opportunity to definitely say, we need to get these things in place. And we either do that through self-regulation, like some kind of things. We haven't been too good at that. We have to admit that, right? And at the same time, you can say, if we do it through regulation, people always think about regulation as solving everything, but it solves it in one jurisdiction. And exchanges are in all other jurisdictions than where the regulation exists. So maybe we need regulation that basically do two things: protect the consumer and keep the space safe, but at the same time furthers innovation in such a degree that you actually want to be there where the regulation is. And if you don't solve both things at the same time, you don't solve anything. So I think that's a lesson, and I think that's what we have seen, because we saw regulation following Mangox, but then exchanges moved away from that regulation, and it didn't really help, because that regulation was apparently not the right one.
Yeah, so I mean, I think there's a lot of things to learn. I mean, I think the number one thing to note, I think Shawn said probably a fraud. I think the answer was this was totally fraud. I mean, I think I think we saw in one of the SEC filings this morning, and correct me if I'm wrong, guys, but Alameda borrowed whatever $8 billion from FTX, and then Sam loaned $3 billion of it to himself. I mean, that's totally fraud. That's not like a little bit fraud. And I think that's getting really misportrayed in the media. And I think it's our job to fix that, because they're talking about like, oh, we can't go through with this effective altruist, this or that, and like all this bullshit, where at the end of the day, this was fraud, right? There was stupidity in our industry, like the lack of risk management, the fact that funds said we had 90% of our money on FTX. That's still really terrible risk management by the entire industry, right? I think, I think some of the things that we need to take away from this is, if the yields feel too high, then you are the yield, right? Like there's I think there are clearly takeaways from this, but I think what's needed as an industry, like people need to step up. And I honestly think Brian Armstrong, I'm going to call on him. I think he needs to be the leader of the industry. I think he needs to step up. Coinbase is a publicly traded company that fully discloses all of their financials, fully discloses their balance sheets, is based in the US, right? And say what you will, right? They've had mistakes with their NFT things. They've had internal issues and things like that. At the end of the day, they've existed for 8 or 10 years. They had a couple billion in EBITDA last year, right? It's a real business, right? And I think we need real businesses with real leaders that are regulated, that are transparent, to step up and kind of take the realm here and be adults in the room.
Yeah, I think just it's hard to add to both of those, but I think the only thing that I can say is that you can really, there's an old saying in crypto, not your keys, not your crypto. There's a lot of truth to that. And not only that, but you should really not put it all in one basket. You can get hacked, you can lose a large sum of money, but it should never be all your money, right? So, and you can have a counterparty, you can put it on multiple exchanges, but you should not put it all on one exchange, right? And I think that people were just foolish in some of these behaviors, and then the lack of transparency when there's transparency available is ridiculous, right? I mean, you can actually monitor what's happening for a lot of this activity, and I think that's why a lot more people like myself, I'm much more interested in DeFi than I ever was. I've been way down the rabbit hole for a really long time, and also, how do you do custody, right? So I think that those are things that it's important.
I think really quickly, I think we got to be careful on the DeFi thing, because we're forgetting all of the hacks that happened in DeFi earlier this year and all of the scams and all the rest. I mean, Mango Markets wasn't that long ago, right? Everyone is immediately looking to DeFi as the savior here, but we just got to be careful.
Yeah, I agree with you, Josh. There's definitely
one comment I think though, right? I think, and it's I love the DeFi projects. I love that industry, and I'm totally a coder and hacker myself, and love all of that a lot. And I love the speed and everything you can get into development. But there's one thing that's like lacking in the industry, and that's like corporate maturity. And if you see companies that's like 10, 15, 100 people or so, with no corporate controls, no like build up of like normal corporate functions, managing billions of dollars, we've always seen in the history that that never works. There's a huge risk of that. And venture that moves in and values them at that price, and I say projects because it could be a company, but it could also be a DeFi project, and it could also be a token, and it could be anything, because someone goes in initially and basically are the market maker that puts a high price on that one, and everyone gets in there. But at the same time, you have a company without any corporate maturity with its responsibility. So in DeFi world, that means that the code audits, like time to market, is like the most important thing. So the code audits might not be the best, and the hardening of the code is not there. Maybe release it a year later. That's better. On the exchange side, yeah, FTX is probably the best example there, right?
Yeah, it's just profound to me. I mean, it's how buttoned down we are, as small as we are. And I know that, Michael, you've got to go through hell with all kinds of regulatory audits and controls and, governance. Oh my God, right? Like, can you imagine operating that way?
Right, exactly. Right. How can they pass the KYC AML thing? Yep. I mean, those are big conversation. And my next question, I think it's more towards Shawn, based on your model. So I think the crypto data on blockchain, all these on-chain data, it's free, right? So why would your clients pay for your services? What are the value-added services you provide to your client? I kind of understand Chainalysis and the type, and can you talk more about that? How difficult for you to pull the data and add value to your data?
Yeah, so I think the biggest misconception about blockchain data is that it's free and it's easy to get at, and with Bitcoin it's a little easier. But once you start to get into any of these protocols that allow people to write applications on them and have virtual machines, what you basically have is you have a globally distributed database, you have an application server, then you have an application on top of that. It's literally recreating a full stack. Plus there's a incentivized economy and a cryptocurrency all in top of that. And the raw blockchain data is absolutely useless. There's no state between one block to the next block. You have to recalculate everything to understand the value, the balances, the flows, what have you. So what we do is we reduce the complexity for our customers from an on-chain perspective to be able to do the calculations and aggregations and create the time series and then parse the transactions and interpret those, so they don't have to spend tens of millions of dollars in years to learn how to do that. We can just make it so they can just go. Now, from a market data perspective, it's also incredibly complex and operationally challenging to connect into 30 different trading venues that their APIs are changing all the time, and then collecting high velocity, high fidelity data without losing it. And it's incredibly expensive to do, incredibly hard to do operationally. And that's why people pay us a lot of money, because it's hard, and it would take them years and tens of millions of dollars to build what we do and make, for the cost of an engineer.
And I'll add something to Shawn's point, because we also pull some of our own on-chain data as well. Mm-hmm. It's also normalizing the data across chains, right? Because the structure of the data on different chains is going to be very different. But to Shawn's point, it's also not the raw data that's valuable in and of itself. I could be like, here's 30 terabytes of Polygon data, but what are you going to do with it? Right. At the end of the day, it's how you convert that data into insight and actionability, right? The way that Michael does that, right, is tracking market participants and tracking flows and seeing what's going on, right? And for Shawn and I, there's differences in how we do it and what we do, but like a lot of what we're focused on is very specific, like financial, like protocol related revenue things and usage metrics and retention metrics on chain, right? Where if you just looked at the chain itself, you wouldn't get any of that data, right? It's how you manipulate that and how you make sense of that and how you're able to deliver the value, but also in being able to do that across disparate chains where the actual structure of those chains are totally different and how they even calculate, like certain chains, a transaction might be actually one transaction, other chains, that same type of transaction might take 7 separate transactions, right? So it's not as simple as you have fun paying $30,000 a month on AWS just to support a couple chains, right? Or whatever, $1 million. I'm sure Michael's way beyond what Shawn and I are spending. So
Right.
So before we
You're
go
good
to
at
Michael,
sailing on AWS, yeah.
So before we go to Michael, Josh, just help us understand how you can help your clients make better decision in the crypto space. You talk about you pull on-chain data, you have the screen like Bloomberg. How is it different from providing equities data to equities investors in the crypto space?
Yeah, I mean, it's the way that we treat crypto is not that different. We're all about helping our clients make decisions with conviction. And if you look at a single data set in isolation, right? If you go on Twitter and you look at what people are tweeting, they're tweeting one metric on a chart and they're saying, oh, this is the reason that this asset moved in this direction, right? Or they're looking at a metric like TVL, which is total value locked, which doesn't even make sense for certain products. So they're looking at something like protocol revenue, where like, yeah, Uniswap has a lot of protocol revenue, but revenue doesn't accrue to the token holders of Uniswap. That's not how the token itself actually works. And so what we do is we really help you build conviction in asset, right? When you're making an investment, right, you want to look at the market data, the sentiment. Are people excited about this asset? Is there web traffic going to it? What are we seeing from an on-chain perspective, right? Like, are the early holders or investors selling out of their position? If they are, that's insider trading. They know something, you probably don't want to hold it, right? Are developers moving and starting to build on this chain, right? Like throughout all, you need to dive into all of these different metrics to build conviction in your decision. And so really what we help our clients do at the end of the day is be a lot more sure of the decisions that they're making.
I think this is the best panel I've been on all year. This is so much fun. So with us, we're actually very similar, but yet very different from Josh. So with us, our customers are primarily programmatically acting. So they're identifying opportunities, they're quantifying risk, and they're acting. For example, all decentralized exchanges have a constant function product that calculates the price of what the asset should be based upon the pool. And our customers are, and that dynamically happens based upon the price inputs in the DEX. Well, prices on exchanges that are trading around the world happen in real time. There's arbitrage that gets done across those things all day long, and our customers are the ones that are doing that. Our customers are also doing arbitrage in each of the DeFi lending protocols, say Aave, Maker, Compound, and they're actually cleaning up the systemic risk, taking out unhealthy actors, and they get paid a premium, 10%, 20%, to clean up that risk, which actually makes the protocol healthy, and why many of these protocols have survived so well through everything, all the volatility that's going on everywhere else. Additionally, we have firms that are maybe they're a bank and they're creating a non-deliverable, they've created and are trading a non-deliverable forward, which is effectively a synthetic future that doesn't settle into the underlying Bitcoin or what have you. But they're also trading against what's happening on CME, because it used to be FTX was the only place you could trade US dollar denominated derivatives. But now it's banks, ironically, and the CME. So if you're a bank and you can't hold the underlying and you're not trading on CME, but so you need to know what's going on chain, you need to know what's going on the centralized exchanges, you need to know what's going on in TradFi. And then the last piece is when they do they do the research, then they write the code to actually build and do this. Then once they deploy it, they have to build the risk mechanism. Okay, I have a bunch of my assets in stable coins. What's the variance from peg on those stable coins? Is it a risk off day? Everybody's flowing into stable coins, out of stable coins. What are happening across chain bridges, etc. And then lastly, you have to be able to account for all of this, because at the end of the day, we all have to pay taxes. So, it's similar to Josh, but different.
Got it. So I think the next question is pretty important, Michael. I still think some people, or maybe many people, still believe Bitcoin and the blockchain network is mainly used for illicit activities. So based on the data compiled by Chainalysis, I mean, how much of the on-chain activity is actually fraud related? And how difficult it is to actually hide these transaction or ransom payment or on blockchain without being caught? Can you talk more about that and tell us about your insights on this topic?
Yeah, definitely. So if you look at the amount of criminal activity, it's been the metric that we've been tracking year over year since the inception of Chainalysis. And if you go back to like before Chainalysis were around 2013, we were talking about 10%. It's like a lot. It's more than 10% actually. Like that was a criminal activity on the blockchain. It's pretty bad. It's probably good we didn't know about that at that time, because then we wouldn't probably never have gotten involved, none of us here. So that's one of the things here. The other piece is like it dropped dramatically once there was tools we became available for law enforcement to investigate and crack down on this activity. So every year we saw like a drop in criminal activity and a change in what actually happened. If you look at it today, it's 15 basis points. Just for comparison, we looked at a good comparison. It's like credit card, not just fraud, but criminal activity happening in LATAM is 30 basis points. So it's bigger than in crypto. So it's actually a pretty healthy system that way. And if you then look at for last year, what was really the big problems there? The biggest one was scams. And scams are typical something that happens in a bull run where everyone wants to get rich tomorrow and believe in everything. So that was a clear part of it. One of the further down, we saw hacks as a big problem. And then even further down, we saw ransomware. This year, hacks have grown a lot and it's like a big problem. And it's back to, I would say, what I mentioned before, like corporate maturity in projects. That's a need. And I think that that when you then look at like we measure that one, you say like how hard is it to then hide? What can we do? How can we find people and so on? And I would say a few years ago we could identify it. Then we became even better than identified and also like find the bad guys, following the flow of funds, and suddenly it could lead to prosecutions. But that was typically years after something happened, and that usually doesn't mean that you get a lot of money out of that, because they've been spent on Lamborghinis at that time. So now what happens is that it's way faster. So we are extremely fast in the flow. So before, for example, a few years ago, we were part of solving the Twitter hack, where Twitter got hacked. And it took like less than 10 days from when it happened to the people were apprehended. So that's like very, very fast. And when we look at ransomware happening today, we saw the Colonial Pipeline hack, where we were managed to claw back all the funds and freeze them before they could get in the hands of or they could launder the funds. And we saw the same again with the North Korea hacking the Ronin network with Axie Infinity, where today we claw back 10% of the funds, and that's like real money, because we talk about 600 million getting stolen, and the majority of the rest of the funds is still sitting out there because no one knows how to move them without us like intervening in before that. So it has become a lot harder to launder funds, and you talk of even for North Korean hackers that are like state sponsored, it's like very hard. So it's not something I would recommend. Don't use crypto for bad things. You don't get away with it.
You're a preferred chain among criminals now, or
It's still like, I think what really matters here is really volume and liquidity, and that's Bitcoin, right? It's Bitcoin for liquidity. Yeah, you can move it in and out of other assets to try to obfuscate, but again, if you want to steal big amounts, and like that's typically the focus is. If it's $100, it doesn't really matter because no one will probably like look for it anyway. But if we're talking about millions, you need a chain with enough liquidity.
All right, I think the message here is just don't steal the fun, because we have Chainalysis, right? So I guess we are running out of time. Again, thank you, Josh. Thank you, Michael, and thank you, Shawn, for your participation and also for your time. And thank you all of us for joining this section. Thank you very much. Have a good day.
Thanks, you too.
Bye-bye.